What's up everyone? uh, in this video I'm going to talk about how to trade safely and smartly in the stock market trading. Penny stock trading, if you are trading the most volatile penny stocks, it can be sometimes very risky because of the volatility that comes with extensive risk while trading in the niche of penny stock. However, the potential gain of making money from the stock market is very high, but also you have to have some sort of risk management and some sort of strategy ready to put into effect when things go wrong while trading. That is the fundamental most important thing for any trader, whether he is or she is a new trader or someone is experienced. Always have to be prepared to put those strategy ready while things go against you, while things turn into a different dangerous situation. This video is going to be long. I'm going to talk about all the dangerous situations where you should not consider trading, and when for you to get out from the trade when you see the potential kind of risk type of situation that I'm going to discuss on this video. First of all, trading penny stock is very risky. You have to have experience and strategy ready, and you have some sort of expertise while trading the penny stock. um, in the beginning of the video I talked about how to trade safe and smartly. In order to being smart while trading penny stock or even the stock trading, you have to have some sort of strategy. That is the most important thing. Oftentimes many people don't know about this strategy, or they don't simply dig deep while trading. They don't have some sort of risk management skill and some sort of strategy ready when things start to go against them and the situation turns out to be very risky and dangerous. The bad traders, they stick and hope, and they expect some of the things on the price action. They keep waiting rather than they should take the action in order to get out of the trade. They don't realize this sort of high red alert type of situation when they need to exit out of the trade, when they need to get entered into the trading. So this video I'm going to talk about those type of situation. First of all, you should always consider trading in the morning. If you trade the penny stock or even sometimes the blue chip, big type of companies, sometimes you have to uh, get in early. That's because sometimes the news, when the company announce some sort of big news, they announce it early in the morning. So in between, like sometimes 4:30 a.m., 5:30 a.m., sometimes even 6:30, 8:30, during that time in the morning the company tend to announce some sort of big news, uh, and the stock price react immediately when they announce this sort of big news. Some of the good news you should look forward if any company like wants to do any merger and acquisition with a potential big company. That's number one. Second thing, if any small company like penny stock niche category, if they partner or do any sort of dealings with potential big reputed company, when an big company's name attached to a very small company, the small company's stock price tend to go up high, and oftentimes they will going to have some sort of partnership in regards to their certain product or uh, services that the other big companies are acquiring, and they get some sort of contract, big contract, 40 million, 50 million deal. They have received some sort of deal. Then the small company's price is going to react, and the price immediately go high because of the good news that has been published. Sometimes it comes out without the press release, and on your brokerage account, on the news section you can see any news that has been published. So that is a good indication of the price would going to be keep moving up. So that's number two thing. The big company, if any sort of small company do sort of dealings with big companies, that's a good sign. Like you should get into bidding that stock of small companies, which should going to be potentially price would going to move very high within a very short period of time. The next step while trading this sort of risky penny stock, the next thing comes with extensive risk. What that means is after the big company have done some sort of dealings, 60 million 70 million types of deal with a potential big company, sometimes even it reached to 1 billion, or they have received some sort of international contract or local contract to uh, supply product and services to the big companies. That's sort of good news that often led the small companies price to go up. But later, after announcing the big news, you should always be very cautious and worry about like the what it going to happen next, or what usually happens next. Sometimes even the good news gets priced up very high. The stock price of small companies tend to go high, but later, because of the good news has been published, the news is amazing, the news tend to react the small companies price to go up. Later, after like 2 or 3 hours later, or maybe 4 hours later, after the price being moving very up, then it began to crash. Then the price began to drop down, because the good news have jumped up the price of the small companies to go up. But that's not a total valuation of the company. The stock price might react for some hours or some minutes, but later, eventually, whatever the money that have on the small company, according to the uh, income statement, monthly yeah, that according to their cash available on the stock, then the price would going to be falling down and matched up accordingly how much the money that the small companies have on their cash balance. So that's why even if the news gets very the news makes the stock price to go up, but eventually it will come down to the level where the small company have the amount of cash available on their on the company, so it will going to fall down. So in that type of situation, you should always be very cautious and careful about riding the momentum, but try to be early. That's why I'm saying, like, to be on the pre-market, to be on the morning, especially because this news comes up in the morning. So when you see the news has been comes in the morning, then if you bid that stock with that good news, you can ride on the momentum as the price is moving up and up and up and up. You ride on the momentum, and when it begins to fall down, you just immediately sell your position and get out of the trade and take some good profit what you have made. That's the thing. That's what I'm saying. Timing is the most important thing, and to be early, to see the news. Even you have missed out some of the price action, it doesn't matter. Whenever you scan, you run some sort of scanner on the morning, and you see what are the companies that has been moving like 50%, 60% up and onwards, then you get into the stock, buy the stock, because 50%, 60%, even the price has moved 50% up. Then those type of stock oftentimes they move even more further. Like, even if you bid on the 50%, it already moved high, but the stock price may go to 120%, 140%, 150, 160, or 70%, sometimes even 200% it goes. Then obviously it crash. So you don't want it to be bidding on the very high extensive price mark. Rather, you should bid early and ride on the momentum. That's how you make the profit. So always know like what happens after next. So what happens when this sort of things happens? And this is not something that happened for the first time. This is happening almost every day, every single day. Any news that comes up, the stock price, move up to 50 or 60% up, then it keeps moving till 120, 130, 140%. Then in probably at 10 a.m. or 11 a.m. time frame is not that important. You should not care about the time frame. That 10 a.m. or 11 a.m. you should consider exiting. But what I'm saying, like the price action that's after happening, you should get out of the trade, and you should know always like how the stock price move and how the finished things happens. So if you know the process of reaction of the market that's keep happening every single day, week after week, months after months, with several many different types of stocks, the same thing, like price goes up, then it begins falling down, then few after a moment later that again it spikes few minutes for long, then again it keeps dropping down. So that's the thing. I mean, you should go long and you should bid on the momentum. The reason I'm saying you should consider going long, not going short, is because I mean, even if you want to short the stocks, shorting is means like when you bid against the price move of the action, like when the price action of a certain stock goes down, you can even make money if the stock price is moving down on the downward direction. That's called shorting. And if you bet against those type of price movement, sometimes I mean you will going to make a lot of money, that's true. But oftentimes when the stock price moves very up very quickly, oftentimes it's very difficult to get shares to short. Even if you use any reputable broker, sometimes it's very hard to get, especially if the stock price has moved like 160, 170, 140% up. Then after at 140% level, to get any shares at that price range, I mean everybody knows that stock price is going to go down. But for you as a trader, for investor, oftentimes we don't get the shares to short. The broker don't get any shares to short. In order for us like trader to borrow the stock from the brokerage firm and then to short the stock, we often don't get those stocks like the shares to short. So that's actually is the main reason why you should not only consider about shorting, because shorting is I know it's very fun to short, but it comes with a great risk, and also at the same time to get shares to short is a big challenge. And sometimes, oftentimes, most of the times we don't get shares to short, even if we know like the price is surely about to go down from after certain point. That's the risky thing with short selling. Sometimes you will you will get I mean short sell, but after like 2 or 3 days later, or maybe 1 day later, when the price actually falls down, then you might get some shares to short. But the price of falling down from the initial level, let's say for example when the price move actually 140 or 50 or 60%, from that point, if you could have short the stock, get lucky to get the shares to short, then you could have made much more money, because the stock price would be falling way too much. You could have made money, but you don't get shares to short. So that's the thing, like so even sometimes you get shares to short later, like 1 day or 2 day later, but the price falling would be like 10-15%. It would not be much from that point during the first green day, when the price of the stock moved 140 or 50 or 60 price 50% price mark level. So that's what I'm saying, like in the long, like if you are long, and from that position you can make money by going long, and of course you can make money by going short, but to get available shares to short is a big challenge. Oftentimes you don't get. So that's what I want to make that as a point, so that people be aware. that to get shares to short is not that easy, especially on the first green day when the stock price has been moving like 140%, 160% up. To that point, to get the shares to short is not that easy to get. And also short selling is also very risky. Sometimes uh, let's say for example, if you go long, the stock price might you might have the possibility of chances to lose maximum 100% of money you can lose. But if you do shorting, oftentimes how much you can lose is unlimited value. Sometimes the stock price, if like you short the stock, let's say for example at 1.6 160 price range, and you are expecting the share price to go down, but oftentimes if the risk thing happens, like the stock price keep moving up and up and up, then it reached to 4, 5, 6, 7. It went to 7, like price mark, let's say for example. At that time you might be losing like 5 times more, 3, 4, 5 times more what you have on your money. So even if you have like $20,000, if you lose, like that's type of short selling, you can lose 5 times out of money. Like you can be losing, if you have like for example $20,000, but you might be negative $100,000, and your broker will owe you money, and you have to pay uh, almost $100,000 to the broker, because you have lent some money from the broker shares to short. And that's the risky thing with shorting. If you go long, you can maximum lose 100% of money. Like say for example, if you have like $20,000, you might lose $20,000, or maybe 50% money. If you lose, you might lose $10,000. But if you do shorting and you don't have some sort of risk management, then the stock price, if it moves like 5 times more higher or 3 or 4 times higher, then you will be also losing like 3 times higher than what you have actually on your brokerage account, the money. So eventually you might end up losing $60,000 even if you have $20,000 in your brokerage account. So that's the risky thing. Sometimes people don't have risk management, they become stubborn, and sometimes some people lose $100,000 out of $20,000 portfolio. So that's why short selling is too risky. You should always have that sort of risk factor in your brain, back of your brain, what might potentially the big losing factor might be, and always consider while trading your exit into an exit point according to the risk level. So that's number 2. Number 3 is if any stock, I know it's very risky thing to say, but if any stock price, the company is near to bankruptcy, and the company have already been filed as chapter 11 bankruptcy or something like that, oftentimes near to the bankruptcy, the stock price tend to rise high. It rise almost 50 or 60% up, then again it drops for a while, then again it keeps going up for more 50% up. It happened for several different types of company in the past. I see JCPenney, the ticker symbol is JCPs, for example, when the stock price came down as 15, like 0.15, 15 cent, 0.1560, that is 15 cent. So from that point it went to 20 cent, then again it came down as 18 cent, then again it went up to like 24 cent, then again it went up to 30 cents. So even if the company announced bankruptcy, so sometimes the bankruptcy announcement or this type of situation, oftentimes near the bankruptcy point the stock price often tend to go up. Of course you have to be very aggressive and you have to be very fast in terms of getting out of that trade, and you should know about the risk factor, not to hold any bankruptcy company for a long time, because when it goes to the bankruptcy you will lose everything. Sometimes it's being like restricted trading on like Nasdaq or NYSE, then it again it starts trading on the OTC market. So that's what I'm saying, like near the bankruptcy, when you are bidding the stock, it comes with extensive risk, but the reward is also there, but it has some sort of risk. For you to gain, you have to have some sort of experience of seeing many bankruptcy related plays, and be aware of when to get in and get out very quickly. You should not hold that sort of stock at, especially at that point range, but you can make a lot of money from that point, but it comes with a risk. Just let me tell you, you just do that research and see. I mean, there are many examples of bankruptcy related companies which like near to the bankruptcy level, even if they announce like bankruptcy, the before announcement or after the announcement, the price tend to go like 50-60% up, then again falls down, then again it went up like 50 or 60% up. So it happens often. So for a trader, people who likes to get in and get out very quickly, they can take some quick profit out of this type of price movement. However, for people who are looking forward to hold the stock for a long time, you should be very cautious. You should be very aware of not risking a lot of your money, because it's risky. For short term gain, you can get in and get out and take some profit out of it, but for the long term it's very risky. Same thing happened with LGCY. That was a company, it came down as like, when it came down to 16 cent, then it started with this sort of crazy price movement. Then it again went down to 7 cent, then again the price moved like nearly 9 cent, 10 cent, then again price came down to 3 cent, then again it went to 6 cent. I mean, it's a lot of profit. If the stock comes 3 cent and like goes to like 6 cent, almost 100% money you can make. If you put $20,000, 100% gain, it would be like $40,000. It's amazing near the bankruptcy play. But again, the company went bankruptcy, and some shareholders who are holding for long, they end up losing big, and the stock end up trading on the OTC market. So that's what I'm saying, like it's very risky. If you are short term like trader, get in, get out very quickly, you can take some profit out of it, and that should be your strategy and goal if you want to make some quick money. Also to consider the risk along the way. Next, how to trade smart. Have some sort of strategy and rules ready. You have some sort of strategy put into effect when things go wrong. For example, if for your risk management, you should only get in to the point and bid at that point when the stock price is moving in the upward direction, not downward direction, or for your any sort of expectation. When the stock prices begin to go up and up, you just bid on the stock, ride on the momentum, make 15, 20, 25% of the profit, and then quickly get out. That should be your goal. That's how you make money. But oftentimes, I mean, you need to manage your risk. Let's say, for example, what if the stock price, did not went through according to the way you planned? So if the stock price, you expect it and you bid for that reason, the stock price would be going up. But what if you see like the stock price keeps going down? It went down to 2%, 3%, 4%, 5%. At that point, you should not consider holding that stock. For any smart trader, when things don't go according to the way you planned or expected, you should get out of that trade immediately, trying to make your losses small rather than it going big. And if you can get out of the trade like by taking 3, 4 or 5% loss, that is the thing you should consider to doing. That is the thing you should do. That's how the smart trader do. Like when they see things did not went according to the way they planned or expected, they just get out of the trade. And even if they have to take like 5% or 4% or 3% loss, they exit immediately. That's the characteristics of a good trader, because they don't make their losses go big. Bad trader, on the other hand, they become stubborn. They think like this stock price is going to go up, they keep holding the stock, and the stock price keeps going down like 5% to 7%, 10%, 12, 13, 15, 20, 22, 25, 32, 35%. And after a while, bad trader realize they lose a lot of money. And that's the characteristic of a bad trader. They keep on holding rather than focusing on the price action. Whereas good trader, they exit even if they have to take 4% or 5% loss. They exit immediately. They make their gains over time go big while keeping their losses small, and they win more often than they lose. And when they lose money, they keep their losses small, and when they're gaining, like winning, they make sure that their amount of gain remain bigger than what they lose. That's how they manage their risk, and over time they make more money because they make their gains bigger than the amount of money they are losing on any trade. If you can exit out of trade taking 3%, 5% or 4% loss, and while gaining, if you can make like 15, 20%, even if you have like 4% loss, your gain is still 16% gain. And if you keep winning more times than losing, like one trade you make 16%, another trade you make 20%, another trade you make gain as 10%, another trade you make gain as 5%, and on a certain trade you made a mistake and you realize that you made a mistake, you are losing money, and you get out of that trade, like taking, when you realize that you made a mistake, taking 3 or 4% loss, then overall, you win 4 times, lose 1 time, but when losing, you just make your loss small. So overall, what happened? Your win becomes more bigger than your losses, and that's how you make money. Oftentimes you will make a mistake, but the thing that makes difference from a good stock trader to a bad stock trader is good stock trader, they manage their risk. They don't hesitate to exit out of any trade when they make a mistake, and they make their losses remain small, like 3, 4, 5% or 6%. But on the other hand, to any bad trader, they keep holding the stock, they become stubborn, they become thinking like no, holding and hoping, and they think like, oh no, the stock price is going to go up, let me hold for 5 more minutes, let me hold for 3 more minutes, it is going to go up. That sort of price action, even the price action is going totally against them, they don't manage their risk, they don't exit out of that trade, and in this way they make their losses go big. And sometimes with one single loss, they keep making the loss so big that all the gains they have made for 15 days of trading or 1 month of trading, it all got like lost in one big loss. And sometimes if you are bidding like the most volatile stock, the stock that has been moving like 140%, 180%, from that point sometimes the company often do offering, and sometimes the company does offering when they need cash. They do some sort of bad financing where the stock price went up like 180%, then suddenly they announce some sort of offering, and they give their shares at a very they sold their shares at a very discounted price, sometimes 50%, sometimes 60% discount price. So from like, even if the stock price has moved up 180%, with offering, after giving like on a certain institution, they have sold like 40 million shares as a direct offering, or 50 or 30, 20 million or 10 million shares as a direct offering, and they gave at a discount price like 50% less or 70% less. So the stock price immediately react and it crashed big, 60% went down immediately. So if any trader holding that stock from at a certain big high point, if they end up bidding at that price, peak of the price moves, so when the offering happened and the news just comes out to the as a press release, I mean the stock price is going to react immediately, and sometimes the price goes down like 60-70%, whatever the discounted price they have offered, and the price begin to crash too quickly, like very quickly the price began to crash, and people who kept holding the stock, they end up losing big. They lose like 50 or 60% within just 5 or 6 seconds. You can't even exit out of the trade by giving sell order. That happens so quickly. So that's what I'm saying, like, to be aware of what happens in the penny stock niche, what happens when the price moves up 180%, 140%, from that point you should always have some sort of uh, alarm on your head, like things is happening from in the past, like lot of different companies, like they do offering at a certain point, and within few seconds the stock price just went down big, like 50-60%, 40% down, very short period of time. So you should always know how the penny stock niche actually sometimes works. Sometimes the risk things happen, sometimes this sort of things happens on the penny stock niche. So by becoming aware of this sort of things happens on the stock market, and you should not be on that boat when things happen during that exact same type of situation. So always it's better to have some sort of awareness within yourself, so that you remain aware of what potentially wrong thing might be happen, and what are the risk factor that are associated with trading and holding that stock for a long time. And also, while like calculating the risk factor and also the potential gain factor, the risk reward things, you should always consider the risk factor and should be very cautious and very alert. That's what is very important. And those people who are good traders, they learn from their experience, they learn from watching other stock price movement, and they become aware of not to be on that certain position when this type of dangerous situation might happen, and they might be end up losing big. So they always remain alert, stay alert, and they protect themselves by being very safe. And like it's almost always better to exit earlier rather than exit later. It's always better to take small gains and be satisfied with it rather than holding for a long time and try to take a bigger portion of profit. It often is better like to take your profit small, and don't be hesitate to get out of any trade when things about to go wrong, or things about to going wrong. It's almost it's very better like to take a small profit rather than risking too much. If you can like take 10%, 15% profit, of course you can make 30, 40, 50, sometimes 60% profit from one single trade. But even if you take 10% profit, 5% profit, 15% profit, and play the trade safely, it's almost better than risking taking a bigger loss, I mean taking a bigger risk. Sometimes even if your gain becomes small, like 15 or 16% or 10% gain, but it's often better to remain with and be satisfied with the small profit, whereas you can definitely could have made much more profit, but it's often better to play it safe. If you like to take like 5%, 6%, 10% profit and exit out of that trade quickly, if you can keep doing it over and over again, even if you could have made much more money, because this thing happens on the trader's mind, they sometimes even after making 15 or 18% profit, they become upset. Oh my god, I could have made 40% or 60% profit out of that trade, I should have held the stock longer. This type of mentality, sometimes if the trader got lucky, they can get 40 or 35%, 50 or 60% profit one time or two time. But often if they have this sort of tendency for longer period of time, often time they will eventually end up losing big. Like I said, like the offering happened and within 5 or 6 seconds the stock price dropped like 50 or 60%. Sometimes even if I saw like a company gave 75% offering, they did the offering at 75% discounted price, and the stock was like GNUS. The stock price went down from 180 to nearly to 35 cent a share. I mean, that was a horrible situation to see. I feel so much bad about the people who bid at that high price mark. I mean, they have probably lost a lot of money. It went down to 180 to 75 cent, then again keeps going down to 35 cents. So it was a horrible thing. So this sort of risk thing happened, on offering. I remember one time I have lost like, yes, I have lost 240%. How can you lose 240% when you should supposed to be losing only 100%? But I lose like 240% in one trade. How is that possible? I mean, the thing happened like, I don't remember the ticker symbol, but I kept a screenshot. Sometimes I often see the screenshot and I realize and remember those pain with very big pain on my heart. And sometimes I remember those things because I have went through this type of situation, big loss. The stock price went to 560, $5.60. Then suddenly they did the offering at a very high discounted price. I went down to like it directly fall within 5 seconds, and the price was from 560 it came directly to 212, and the price keeps going down. I exited from that point. It happened within 5 seconds, then the price again going up. Then I ride on the momentum thinking that I would cover some sort of loss while I was going to make some sort of profit. But when the stock price moved to 240, again it got dumped and the price went down to straight 125. And 240% loss I have had during that trade. I mean, it was a horrible thing. The price even went more further down to 75 cents, and almost it has become like 6 months. The price never recovered yet. It's going up like 88 cents, 92 cents, then again coming back to 78 cents, 74 cents, then again it jumped to 104, 112 and all that. So this sort of thing, I mean, I remember that pain. I lose nearly 240% out of one single trade. That's what I'm saying. Like, it's almost better to take some profit quick rather than holding for a long time, because when the offering happens, the price may went down 80%, 70% very quickly within few times. Even if you put the sell order, by the time the offering happens, the price goes down so quickly that your order will not be even executed, because it takes some time to give the sell order or buy order. So very risky. I mean, that's what I'm saying, like, to always be alert of the potential risk factor, not to make the mistake. It's better to take small gain rather than holding and hoping to take bigger profit, because sometimes this sort of strategy you may get lucky for 1 or 2 times, or maybe 3 or 4 times, but in the long run, if you have this sort of tendency and you do very aggressive type of trading by holding for long period of time, in the long run this strategy, oftentimes a bigger loss would going to hurt you a lot and would going to cut all your gains within one bad trade. Every profit that you have made, it all will be gone. That's why it's better, like, to stick with taking a small profit and getting out of the trade earlier rather than holding for a long time. I'm sharing a lot of things with you people so that you can understand and learn from my mistake and strategy, and rather than you losing yourself some big amount, if you be alert and take the education from somebody else's experience, it's often better learning process rather than making yourself the mistake and you losing the money and then realize the mistake and learn from that lesson. You can learn from somebody else's mistakes. That's often better rather than you making big mistake on your own and learn from some other people's mistake. A good, smart people always, learn from other people's mistake. They observe other people, even if they are like working in the company, they don't want to repeat some mistakes that has been done by some other employee. They learn from other people's mistake, other people's failure. They learn from other people's situations. On the stock trading, you can also learn from many traders. Like if they share some of their thoughts, you can learn from their thought process, learn from their mistakes, situations that they share, and you become aware of not repeating the same mistake. It's often better, which will save you a lot of money and will also cost you less money. So that's the thing. The another to be a smart trader, like I said, like you have to have some sort of a strategy. You have to know which news makes the stock price to go up, which news makes the stock price to go down. You should know about the timing, the time frame during which time the stock price tend to go high very quickly, especially on the morning, and to have the right scanner. And also when you scan on the morning, be prepared to bid on that stock and ride on the momentum as the price action is happening and take some profit on the way up. And when things turn to go down, go against you or may not go the way you expected, you just exit out of the trade, even if you have to take 5 or 6% loss. A good trader don't hesitate to take 5 or 6% loss. They know that's not a loss, that's a good discipline. That's not a loss, that's a good loss. They are exiting earlier rather than making their losses going bigger. That's the thing, like the self-discipline, that's sort of thing, separate from a good trader to a bad trader. Bad trader often forget those things. Good trader always remember those things from their pain, and they become aware and they become very much stay alert all the time, and also consider the potential risk factor that might be that might hurt their broker, that might hurt their account. In the long run, if you want to make money out of the stock market, you always have to maximize your gain and minimize your losses. And if you can make more winning trades, win more times than you are losing, and when you are losing, you make that loss not going bigger than 5 or 6%, and you recognize and realize that you have made a mistake, and you exit immediately from a trade. Like, don't hesitate to exit out of the trade immediately. That's the thing that separates from a good trader that bad trader. Overall, their gain remain bigger than their losses, and they focus on the next good trade and they make money out of it. Or if they lose, they again lose small percentage, sometimes 2 or 3%, maximum like 5 or 6%, they are done. No matter what happens, 5 or 6% loss they are having. Like, good trader always exit immediately from the trade. They don't want to participate on the trade. They don't want to hold that stock for no longer, and they just don't want to be on the trade. That's the discipline they follow. While bad trader, they don't follow any discipline. They become stubborn, they become angry, they become reactive, they become very stubborn. I know they become greedy, like I don't want to take a loss, I don't want to take a loss, let me hold that stock for longer, I don't want to take a loss. That sort of tendency, mentality, attitude would going to hurt those traders losing a lot of money. I don't want to take a loss. This sort of tendency. You have to take a loss. Even if you take 3 or 4% loss, that's a good loss. That's a process. Sometimes you have to take a loss, and the earlier you exit, the more better for you. The more better it would be for your account. Not to make your loss go big or not to losing big. It's almost the same thing that happens with every stock, every ticker symbol, every play, every morning time, high stock volatility type of price action. This sort of things happens all the time. It's all about the mentality and psychology. A good trader have a good mentality and psychology, whereas a bad trader, they don't realize those things. They don't have a good psychology, they don't have a good mindset, they don't have good strategy, they don't have risk management skills. They become emotional, they become greedy, they go down. Even if the prices keeps going down, they hold the stock. That are some of the things, are the characteristics of a bad trader. So try to make a chart and try to write down like the characteristics of good trader, bad trader, what separate from a good trader to what separate the characteristics from a bad trader. And if you just stick that paper in front of your computer or a laptop and just remain visible while you are trading, or when you begin trading, if you read that for one time and you realize and remember those rules and that thing, often it will going to benefit you a lot. Oftentimes you will not going to make the mistake. Oftentimes you will not going to be stubborn. So that's also a thing you can attach with your laptop, and in that way you will not going to be someone who will going to be turning from a good trader to a bad trader. Always mindset, like you have to have and keep holding a positive and good mindset. That would going to make you money, that would going to make you rich. Because if you fail to utilize those things in real time, if you fail to be alert on real time, it would going to cost you losing a lot of money, and you're going to be end up falling as someone who is a bad trader. Sometimes even if you're a good trader, sometimes some people forgot those things, and from good trader to they turn themselves into a bad trader. Then at the end of the trading day, they realize that they have made a mistake, they shouldn't have done, they should have exited earlier, and they realize things later. But in real time, what happened? They become stubborn, their head and thinking got blocked. They become like, I don't want to hold that, I don't want to take a loss, I don't want to take a loss. That sort of tendency, mentality strike on their head, and they fail to react. Sometimes they, even if they could make like 20% profit, they hold the stock for more longer because they want to make more money. They become greedy, and rather than taking 20% profit in real time, they end up being greedy. And guess what happens after next? The stock price began crashing, then it went down to 16%, their profit went down to 12%, their profit went down to 8%, and they end up cutting their gains. And sometimes it keeps going down. If they keep holding the stock, then the price it went from a green profit zone to a red zone, where they they made some loss. Their loss becomes 5%, 6%, or even it becomes even more bigger. Sometimes it happens. People, even if they could exit earlier, they could have made like 20% or 22% profit. But since they have become greedy, and they keep holding the stock for a long time, then they make their gain small, and their like the stock price keeps going down and down, and they end up uh, like making their profits even smaller. They end up like from 20% what it could have become as gain if they could have exited and sold their stock, but since they are holding and with a hope that they were going to make a lot more money and become greedy, then at the end of the time, I mean, what happens, the price action starts to go down and it keeps going down, and later they end up making their 20% gain opportunity turn into like 5% gain, sometimes turn into a loss, just because they have become more greedier. They did not took their profit while they could take 20% profit, but since they become greedier, now they have cut their gains, and eventually they have uh, lost what they could have potentially could have gained. They have lost their gains. Sometimes it even, sometimes the price from 20% gain it becomes like 10% loss, because the price seems to go down and down and down. So that's the thing. I mean, it's a very important thing, like to take profit. While it's also important to exit out of the trade immediately, it's also very important to take your profit immediately, to take your profit quickly, to take your profit. It's also important. So that's very important thing. Like I said, this is all about psychology, mentality, and mindset. Like I said, I used to say in my other videos at my channel name is Quick Pro Trading. I've mentioned several times, like trading is more like a psychological thing. It's more like having a strategy, mindset, and psychological thing rather than technical things. Technical thing is important. Like technical thing you can learn any point of your life if you do some research, and technical things, that is not some sort of like formula, or that is not some sort of thing that will always going to be happen in the exact same manner. The stock market doesn't follow those things. It might happen, it might not happen. That is not any kind of formula that it will be exactly happening this same process. It's not something like that. So technical thing, it's not something like a formula, or it's not like something to be a mathematical thing that it will going to be exactly happening this type of thing. No, it's not. Sometimes it becomes unpredictable. Stock market price movement is very unpredictable thing. So while technical understanding is important, to know about the chart, to know about the balance sheet, to know about the SEC filings, to know about your the past indicators, support and resistance level, this sort of thing is helpful. Definitely PE ratio, this sort of thing is good. But the thing is, when in the morning or any time when the stock price, after the news comes, or sometimes without the news, when the price action happens, sometimes the price action happens so quickly, by the time you're going to read out the technical thing, analyze all those sort of technical support indicator and all those thing, the price action might be over, and then you wanted to get into the trade. From that point the price would going to begin falling. So sometimes the price action happens so quick that you even have to get into the stock immediately. I mean, you don't have much time to think about or read about all those sort of analysis, technical things, SEC filings, balance sheet. By the time you will read out all that, the price action will be over. And that's the thing, the price action in the morning, that happens very quickly within a very short period of time, and to do those sort of research, it takes time. So that's what I'm saying. If you have the right mentality and positive mindset, strategy, it's more of a like psychological thing. You get into the trade, you know when you need to get out, when you wanted to take a quick profit rather than holding for a long time. It's all very basic thing, simple thing, but oftentimes people fail to utilize, realize, recognize this sort of simple things. Because of the right mentality and mindset, people often lacks this sort of simple things. They end up being too much technical guy, and oftentimes by the time they realize that technical sort of things, the price action is over. So penny stock, the price movement is, it's like happens very quick. You need to be very reactive, very quick, and you need to uh, get out of the trade very quickly. So that's the thing, you have to take decision quickly, bid quick, and also like to make your judgment quick, and also be prepared to react quickly with your positive mindset, strategy and rules. That's the most important thing while trading in the stock market, penny stock niche. So right now I want to say something about the brokers. I'm been talking about like how to, this is the topic that I'm talking, like how to trade smart, how to be safe on while trading stock market. I want to talk something about the brokerage, which brokerage account you should take or which broker you should use. Let me tell you, TD Ameritrade and Interactive Broker are the two broker which allow you to participate on the pre-market from 4 a.m. in the morning. 4 a.m. I'm telling about New York Times based, New York time zone. So Interactive Broker and TD Ameritrade allow you to trade and participate on a trade on the pre-market 4 a.m. The rest other big branded broker like E-Trade, Charles Schwab, Fidelity Investment, those broker, they allow you to participate on the pre-market from 7 a.m. in the morning. So with TD Ameritrade and Interactive Broker, you can take part in the pre-market from 4 a.m. while with other big brokers you cannot. You have to wait until 7 a.m. then you can participate to trade on the pre-market from 7 a.m. like from E-Trade, Fidelity Investment and Charles Schwab. So that is a big consideration. I mean, that is a consideration you should took. I mean, it's not like you have to trade with only one broker. You can select or trade with multiple broker. It's totally, I mean, up to you. You can even have 5 brokerage account, all of them. So just I wanted to mention those things so that you can aware of that thing. And also after hour trading is like same till 8 p.m. you can participate on a trade. After hour all the brokerage are like same: TD Ameritrade, Interactive Broker, Charles Schwab, Fidelity Investment and E-Trade, which allow you to trade same all the broker till 8 p.m. after hour. Platform about broker, I would say Interactive Broker and E-Trade are very good in terms of if you wanted to do short selling, because those two broker, even if you have like only $2,000 in your brokerage account, you can do short selling. Even if you have like $4,000, $5,000, you can do short sell with Interactive Broker and E-Trade. And Interactive Broker is kind of my favorite because they can, sometimes you get shares to short from Interactive Brokers, and they also send email notification for the stock ticker symbol that you are looking to do short selling but you did not get somehow. But the next day on the email notification, if you select on the setting, you will get notified that these stocks are actually available to short. So that's one thing I really like with Interactive Broker. TD Ameritrade, for think or swim platform, TD Ameritrade, I like it. But if you are long, if you are as a trader you are long, then you should consider TD Ameritrade Interactive Broker, TD Ameritrade think or swim platform. Because For short selling, TD Ameritrade requires you at least to have $100,000 in your brokerage account. Then again, you have to apply, and they take some sort of interest for that. So it's a big requirement. But with E-Trade and Interactive Broker, you can do with having only $2,000. So that's the beauty of having Interactive Broker and E-Trade as your preferred brokerage account. Charles Schwab is also a very big broker, good for long. Short is also good. I mean, sometimes you will get shares to short. Fidelity Investment, I mean, I'm not suggesting Fidelity Investment, to be honest with you, for the short selling, but if you have a margin account with them, you can try. But my most favorite two broker to do short sell is Interactive Broker and E-Trade, and my most preferred broker for long is Interactive Broker and TD Ameritrade Thinkorswim platform. It's good, and also E-Trade is also good. If you take E-Trade, if you take they charge some sort of fee to give the data real time on the laptop, and they probably charge monthly a certain fee. But that sort of platform, if you use, it's too good. I mean, for that, if you implement that, then without going free version, then I would suggest E-Trade is the number one best preference for going long and also going for short. E-Trade is best for going long and for going short. If you take the real-time data thing that charge on a monthly basis as a web platform from your laptop on a monthly basis, E-Trade, that platform is best for in terms of going long and short. However, it totally depends on you. I really like Interactive Broker too, as a doing short or even going long. They're very, very good. TD Ameritrade, I don't. I mean, it's up to you. I mean, for long it's good, but for short, $100,000 they require. So very few people have $100,000 to put on a brokerage account. Some people have, but it's a very big requirement, I think, for new trader or any trader to even consider. So that's the thing. TD Ameritrade platform, and if you are a mobile user, I would say Fidelity Investment, E-Trade, and Charles Schwab. Mobile platform, these three brokerage is kind of same. Only their dashboard or different type of setting, only is a small change, but almost kind of same. Everything is kind of same. Interactive Broker is slightly different. TD Ameritrade Thinkorswim platform is also very slightly different, but not that much. I mean, all the brokerage platform is almost very identical. It's almost very same, with few exceptions. I mean, it's not like any brokerage account or brokerage platform is good or bad. It's totally up to you. You should, I'm suggesting you to have 5 brokerage account open and try all together. Even if I suggest, for the people who are small trader, who have a small account on their brokerage account, they have a small money, for example 10,000 or 15,000, even if $5,000, and they fall under on a day trade, fall under the Pdt Rule. Pdt Rule is something which defined as those trader who have less than $25,000 in their brokerage account. They fall under Pdt Rule. They cannot make more than 3 day trade on a 5 business day rolling period. So they fall under Pdt Rule. They only can make 3 day trade, and that makes them very difficult to get out of that trade. Sometimes they want to make the best use of it because of that regulation set by FINRA and SEC. So that's the thing. I mean, for that reason, I mean, if you have like $1,000 in your TD Ameritrade brokerage account, $1,000 in Interactive Broker E-Trade, 1,000, Fidelity, let's say 500, and Charles Schwab, let's say 500 or maybe 750, and you put $2,000 on Interactive Broker. So if you have like multiple money in multiple accounts, what it will do is, if you even fall under the Pdt Rule, you can make 3-day trade on a 5 business day rolling period. With any broker you will get 3-day trade each. That means if you use only one brokerage account, you would going to get, let's say for example you use only TD Ameritrade, you will get 3-day trade on a 5 business day rolling period. So now you have like 3 brokerage account. Let's say for example you have TD Ameritrade, you have E-Trade, you have Charles Schwab. Now with Charles Schwab you will get 3-day trade on a 5 business day rolling period. E-Trade you will get 3-day trade. TD Ameritrade you will also get 3-day trade. So as you have 3 brokerage account, you can now take 9-day trade on a 5 business rolling period, 3-day trade on each brokerage account. That is the beauty of, for the people who have less than $25,000 in their brokerage account, with splitting their money up dividedly on different broker, they can participate in more day trade. And if you have like 5 brokerage accounts, say for example you have with every broker like TD Ameritrade, Interactive Broker, Charles Schwab, Fidelity Investment, and also with E-Trade. So now you have 5 brokerage account. You can now do a 15-day trade on a 5 business rolling period. 3-day trade on E-Trade, 3-day trade on Interactive Broker, 3 on TD Ameritrade, 3 on Charles Schwab, 3 on Fidelity Investment. So that's the thing. I mean, it's amazing. So even if you have a small account, I think 15-day trade is kind of enough for any trader in order to make day trade and not be bothered by the Pdt Rule. That often helps in order for you to get out of any trade quickly, rather than being emotional and being stubborn and thinking about, oh my god, I only have 3-day trade on 5 business rolling period, I will have to I want to make maximum amount of money. That sort of mentality is bad, and that sort of mentality often happens because people have only one brokerage account. If you have multiple brokerage account, you can actually take part, like I said, you can do 15-day trade on a 5 business day rolling period. I think it's more than enough. And why I'm saying like only the 5 brokerage, like TD Ameritrade, Interactive Broker, E-Trade, Charles Schwab, and Fidelity Investment, because these brokers are big. These brokers are big brand. These brokers have big capital in terms of, these are very reputed big broker. So if you put your money on something, big brokerage companies, your money will be safe. You have less kind of, all the broker are kind of, good. If they follow rules and regulation. But for me to suggest you to go with this big brand broker is because like these are very big brokerage company. So it's often good to go with big brokerage company, to have account with them, rather than going with some small brokerage firm or new brokerage firm, or even online based brokerage firm, or even going with some sort of offshore type of brokerage firm. There are lots of brokerage firm out there. If you Google it, you will see lots of, but I have suggested you only 5. There are other brokers, I know their names. I did not mention their names is because it's totally up to you. Seriously, I don't want to mention their names, but you can also open account with them. But I'm saying only the 5 brokerage account, because those brokerage companies are very big. They have big capitalization, they have big offices, they're big broker, big brand broker, and that makes them really you know kind of uh, protected. Like, I'm not saying, I mean, protected is a very bad word to use, but I'm saying these five big brokerage are very big companies. So if you have open a brokerage account with them, I mean, why not go with the big brokerage company? So that's the thing. That's why I'm like suggesting or recommending. It's totally up to you, whoever you prefer or want to choose. It's totally up to you, but I'm suggesting these five because these five are very big brokerage company. If you Google it, if you do some research, you will know. And whatever the broker you feel confident about, it's totally up to you. I mean, they are also good. It's totally up to you. I mean, Merrill Lynch is also a very big broker, but what happens with Merrill Lynch is they often tend to do high net worth individual, high net worth institution. They want to serve them. They don't, I mean, to open a brokerage account with them, they often have some big requirement in terms of money to be put into the brokerage account. To It's all on the website. So I mean, that's TD Ameritrade, Interactive Broker, E-Trade, Fidelity Investment, Charles Schwab. They don't have any sort of like rules and regulation and requirement. You can even open a brokerage account with them even if you have only $1,000. You can open a brokerage account with them. Even you can have only $500 on your brokerage account, and you can still be able to trade and open a brokerage account with them, with a big brand brokerage companies. You can even open a like brokerage account even if you have like only $500 in each of the brokerage accounts. So that's the thing. And also big brokerage company, all the five I mentioned, today date is 8 August 2020. All the brokerage account, still they are commission free. So in order to trade, you don't have to give them any commission. Like, whether you want to get in to any trade, get out of any trade, you don't have to pay any commission to the broker. So it's free. So why not use them? Previously it was like $6.95 on each trade. Even if you want to bid and exit, that would going to cost you $6.95 on bidding, $6.95 on exiting. Like almost $13 you have to put aside, regardless of whether you make money or lose money from that trade. But now that money is free, like it's totally commission free. So you can take the advantage of. And also the big brokerage company that I mentioned, they are also giving commission free still. It's August 2020. So that's the thing. I'm not suggesting any broker. It's totally up to you, your financial decision, your choice. So it's totally up to you. I'm just suggesting what I think is good, because I've said a lot about the stock market, tips and tricks. So that's why I wanted to talk about the brokerage account, the brokerage firm, because it's very important. You cannot do any trade without having a brokerage account. So that's the most first thing. Also another thing, like if you open any brokerage account, in order to do short sale, you have to have $2,000 in your brokerage account, and it has to be a margin account. With cash, there is when you open up a brokerage account, there's two options. You can open it as a margin account, you can open it as cash account. With cash account, you don't have to worry about the PDT kind of thing. I have totally made one video totally separate and based on that particular point. But with cash account, you can trade many times. You don't have to worry about the Pdt rule. But the cash account have some sort of difficulty. Like it follows T+3 rule. That means when you make a trade, then the money to after executing the trade, the money to transfer into your brokerage account, again it follows T+3 rule. That means it takes almost like it takes 3 days to then the money to transfer into your brokerage account. So it's like a bank account. When you transfer the money from one bank to another bank account, it doesn't happen immediately. It happens like it takes almost 2 to 3 business days in order to the money to process and then again transfer to your bank account. Same thing happens with cash account. When you make a trade, that money will be like, it will going to take 2 to 3 business days for the money to get transferred into your cash account. So that's why you need to, if you want to trade with cash account, you have to trade like the amount of money present on your cash account. You cannot borrow any money, you cannot do short selling with cash account, and also at the same time you have to keep in mind that it would going to take 2 to 3 business days for the money to settle into your brokerage account. And oftentimes with cash account you can also, I mean, you have you do not have to worry about the Pdt rule, but you have to, like, if you have cash money on the cash account, you have to split your money into, like, split your money. Like if you have like $5,000 into cash account, you can trade with $1,000. Then you make a day trade, then it is going to take 3 business days for the money to settle into your brokerage account. Then you have another $1,000, then you trade and make a day trade, quick day trade. Then another 1,000 you put into effect, then make a day trade. So then another $1,000, then again it would going to take 3 business days for the money to settle in again to next time participate on the trade. So by splitting the money in, like subdividing the money, you can take participate in more day trade. Because if you take participate in with all your money, like all $5,000, then what would happen is it would going to take 3 business days for the money to settle into your brokerage account, and for the 3 days you will not going to be able to take participate on any trade. So that's why splitting the money 1,000, 1,500, 2,500, by this way you can make multiple day trades, and the money will be will be back after 2 to 3 business days. It will be settled down, then again you can make day trade. So that's the thing with cash account. With margin account, you can do short selling with margin account, but there are requirements, like you have to have minimum $2,000 in your brokerage account in order to do day trade, in order to do short selling. And to day trade, you cannot take participate on day trade more than 3 day trade on a 5 business days rolling period. I've shared the tips, like if you have multiple brokerage account, all are margin account, then you can take 3 day trade on a 5 business rolling period basis, 3 day trade on each of the brokerage. So total, if you have 5 brokerage account, you can have 15 day trade on a 5 business day rolling period. So that's a good tricks. People who have less than $25,000 in a brokerage account and worry about the Pdt rule, you can do participate by splitting your money into multiple brokerage account. I think that's a very good strategy to follow, to do. I do that, I used to do that, I still do that. So that's the thing. Even I have some big money on some particular brokerage, but on other brokerage account I have less money. So I just do 2 or 3 day trade and use the big brokerage account, the brokerage account which I have most of my money. I use it only for the good trades. Like I know that any potential good play that is so good, that is so amazing, that is amazing, I feel the less risk, I only take participate on from that brokerage account in order to take part on that trade. Because I don't want to lose big, because I am bidding big, and I only want to participate by seeing the good potential chart or pattern that I know that the less possibility of chance there to lose money. I only use that brokerage account and bid with more money That is kind of my strategy. And the other brokerage account, I just don't want to put a lot of money. I just use a small amount portion of my money in order to do trade. Another one good tip I would like to say, if you are trading with multiple brokerage account, try to maintain a calendar. There are calendar apps, and on the calendar apps you can use some symbolic things, like for example, if you are using E-Trade on a calendar, like say for example 7 August. So 7 August, you have made one trade with E-Trade, you have made one trade with TD Ameritrade. So try to put like T1 E1. And on 8 August you have make a trade on Interactive Broker, and also the Fidelity. So I1 F1. On 9 you made another trade with TD Ameritrade and one with Charles Schwab. So T1 C1. What will happen is when you're trying to do more day trade with having like multiple brokerage account, you often will forget the next following day trade because it's a 5 business day rolling period basis. So sometimes you'll forget if you are like trading with multiple accounts, you'll forget the exact date when you can make that day trade. So if you write down and note down on the calendar, it takes only few seconds. So just E1 T1 I1. This way you can see on the calendar app, like on 8 or 7 August you have made use this brokerage account. On 8 you have used this brokerage account. On 9 you have used this certain brokerage account. So 7 till the next weeks, after 5 business day rolling period. So you can see that you have like made already 3 day trade on which brokerage account, and also on the next date which brokerage account you can do a day trade. I think by maintaining a calendar app and writing the day trade that you have made on a symbolic manner, like E1 T1 I1 F1 C1, this way you will be knowing with one calendar app, you will be knowing like from the next following day when you will be going to make, you can make another day trade, or you can make another trade, or how much day trade you have done in this month, in this week. This is a good way to monitor and keep track, because oftentimes if you forgot the date, if you made one extra more day trade, like 4 day trade on a 5 business day rolling period, which you should not be allowed to, so at that time what will happen is your brokerage account, your broker will block you from trading for the 90 days. That's a FINRA regulation. That's nothing to do with the brokerage firm. They have to follow the FINRA rules and regulations. So they would going to do is they will going to lock your brokerage account for 90 days, and within that 90 days you cannot exit if you have traded on a certain brokerage, like certain stocks. And also you cannot transfer your money, you cannot also do bidding trading for 90 days. So it's a big mistake. So that's why I'm saying, like, never to forget the exact date. If you maintain a calendar date, it's a physical calendar or some sort of online based like app, it's very good to monitor and to know about when you can do the next day trade, when you how much day trade you have made from which brokerage account, such and such. So you can monitor always with just writing and taking notes on a